Each week, the financial and popular newspapers and social media channels are full of headlines about companies that have seen their share price soar or drop dramatically in response to the latest crisis of the day. Most of the time, those headlines will be quoting a percentage gain or loss, often at a dramatic level to make for attention-grabbing headlines. It could be the FTSE 100 is up 8%, gilts are down 12%, portfolio returns are 23%. These changes are likely to have an impact on your own investment portfolio. But the difficulty with quoting percentages is that our brains don't intuitively work in percentages. We can just about deal with 10% discounts in a shop, but the minute it gets into a 17% rise, followed by a 12% fall, our brains start to struggle. Well, maybe that's just me. The result is that when our brains start to struggle, we tend to oversimplify to try and make sense of the percentages. Let's consider the headline that a company's share price is up 50% and then down 50%. This sounds like it's back to where it started. Or how about down 30%, up 35%? Well, this draws us to conclude that the share price must be higher now than it was before. But that simplification is sadly wrong, and sometimes it's really wrong. Let me share a chart with you from 7 investment managers that show the reality of percentages, gains and losses. As a picture, our brains understand it a little bit more easily. So this chart shows in purple on the left a series of percentage drops in a portfolio valuation, starting with a 5% drop at the top all the way through to an 80% drop at the bottom. Hopefully that's not something you'll ever experience. So on the right hand side of the visual that you can see the percentage gains that the portfolio needs to experience to get back to its starting point. So a 10% fall in portfolio value needs to grow by 11% to get back to where it was, the starting point. If you lose 25% of your money, the remainder has to grow by 33% to recover your losses. And a fall of 50% or more means your portfolio needs to grow by over 100%. For example, a 75% drop in value needs growth of 300% to recover to the initial value. So, when your attention is grabbed by these soaring share prices or growth percentages, take a moment to consider what's happened behind the scenes in the months or years before the meteoric growth being claimed. You might find the performance is not as fantastic as the journalist claims it to be. And when it comes to your own portfolio performance, be sure to fully understand the impact a drop will have upon your financial fortunes. I would highly recommend that you build a plan, a lifetime cash flow forecast that enables you to create scenarios to illustrate the returns your portfolio needs to deliver to support the life that you want to live. And of course, to understand the impact any significant market declines in your cash flow plan so that you can plan accordingly. I really do hope that's helpful. Thanks for watching. If you enjoyed the video, please press the like button and of course subscribe so you never miss an episode. My name's Justin King. I'm a chartered and certified financial planner. My aim is to help you live a successful life. That often involves understanding your money. I do host a podcast called the Retirement Cafe Podcast. You might like to tune into that. Please check out the description below. And of course, you can sign up for my weekly newsletter, which is hopefully packed with inspiration and tips for a successful retirement. For now, I'm Justin King, helping you live your best life.